Let's start by talking about this increasing hawkishness that we've heard from Fed officials. Of course, Tiff Macklem has maintained that we should be expecting higher rates. But of course, a number of officials this week on the U.S. side of things has been talking about how rate hikes are still very much in order. What's your take on the market? Is it undershooting expectations of higher rates for the near future?
I think central banks globally are just trying their best to thread the needle in terms of satisfying both the market and getting inflation under control. We're starting to see signs, for sure, across many jurisdictions that inflation is coming down, still at much elevated levels. And so until that fight is done, central banks have to be aggressive. But I think the markets, particularly in our world, in the real estate world, has overly discounted what is going to happen with rates going forward.
So does that cause you pain, concern as you look at investments ahead?
Like any business, you have to look at the supply and demand fundamentals. That's really what it boils down to. No one can control interest rates. They can control their balance sheets. And hopefully, if you're a business owner, you've done your best to get your balance sheet in check. It's all about the supply and demand fundamentals. So looking forward, if you have a business that can capture the inflation, you can do things on the labor side to control your costs. Utilities are somewhat out of your control, though we believe we peaked on a year-over-year basis. I think there are good businesses with growth that can either keep margins or perhaps even expand them in this type of environment. If you look at the stock market, I think you saw the first half of the year, multiples came down, particularly in real estate.
Right.
And now it's more of a stockbreaker's market going forward.
Well, it's a perfect day to be speaking to you because, of course, Scotia had stronger than expected fourth quarter results despite profit falling over its capital markets division. The strengths were particularly around the Canadian banking sector. We're talking about residential mortgage volumes up 14% year over year. What does that tell you in terms of the sort of strength and virility of the Canadian economy?
One thing people lose sight of, particularly when they look at residential in Canada, is that, again, if you go back to supply and demand, what we benefit from as a country is the rapid immigration that comes that we see. We have 400 growing to 500,000 new people arriving in Canada every year. So you automatically have this demand buttressing the market. At the same time, new supply has been an issue. Of course, it's been on the condo side that we've had new supply, but on the single-family home side, there really isn't a lot of new supply. So you still have the ability for mortgage growth to occur.
I'll have to ask you later if you would call this a buyer or seller's market. We'll be back with Andrew Moffs. He is Senior Vice President and Portfolio Manager at Vision Capital. He'll be taking your questions on real estate stocks. Stay tuned. Welcome back. We've got an email from Doug. He's got a question. He says, I'd appreciate your opinion on Nexus Industrial REIT.
So Nexus Industrial REIT, 85% of its portfolio, by its name, is an industrial. They still have a bit of a portfolio in retail and office. This is now the only pure play on Canada industrial, now that Summit Industrial REIT is being taken out. It is a good company. I think it's a buy. They do focus on more secondary markets. That's been a good thing as of late. Think of London, Ontario, for example, where they underwrote a certain rent level and they're getting mark to markets much higher than what they originally anticipated. So I think it's a nice little company. It's growing well. We've hit a pocket here where the stock is consolidated, and I think there's upside ahead.
Okay, great. And for the viewers that are listening via podcast, the ticker there, NXR. The next one is an email from Richard, who wants to know about American Hotel Income Properties REIT. The ticker here is HOT.UN TSX. He wants to know, what do you make of this company?
So this is a company that owns hotels in the United States, but listed here on the Toronto Stock Exchange. It's a very high risk, high reward type of investment. Generally speaking, we're bearish on the hotel industry sitting here today. We talked previously about our thoughts on interest rates and inflation. The hotel side is struggling on the cost side, both keeping labor, finding labor, keeping labor, and paying labor, and that's putting some pressure on margins. American Hotel Income Fund, they've done a good job of getting their occupancies back up. They're probably about in the low 70s now. I think peak occupancy was still in the 80s. So they still have a fair bit to go, though they've made it up on the rate side. I think their balance sheet is a bit more on the higher leverage side. So it's probably a name I'd avoid. There's better names if you wanted to own the hotel cycle.
Okay, well, now we've got a caller on the line. Taraver from Phoenix, Arizona. What's your question?
Thank you. My question is on public storage. That's the individual storage company for people. And two parts to it. The first one, they have a Moody's rating. It used to be a AA. Is that still the case? And do you put any credence into that? And secondly, are they growing responsibly with the interest rate and inflation being so high? Thank you.
Ticker symbol here is PSAUS.
Yeah, so Public Storage is one of the largest REITs in the United States. It's the first self-storage company really globally. It is a great organization. They have properties throughout the United States. They do have a portfolio in Canada. This company has a bulletproof balance sheet, and hence it has such a high ratings. It has high ratings from the credit agencies. What they have done is the majority of their financing is done through preferred equity. So think of it as permanent capital that has a set a coupon on it that never has to reset. So whether interest rates are going up or down, you have high confidence in on the liability side. And then if you think on the asset side, the self-storage industry is highly recession resistant, and they've been able to achieve same property NOI growth at a very healthy rate that far exceeds their interest costs. So hence, I think Public Storage is a good name to own. We like the self-storage industry, particularly here in Canada.
Great. We've got a caller on the line, Sean from Sarnia, Ontario. Sean, what's your question?
Oh, hi. My question's on Cap REIT. I know that this isn't a popular pick for the speaker, but just curious if he thinks there's any chance that the stock price rebounds here. Thanks.
Great. And the ticker symbol is CAR.
Yeah, we think highly of Canadian Apartment REIT, the organization. It's a solid management team. This is a great play on the Greater Toronto area, as that's their highest concentration of assets, where we've seen the highest rent growth. Of course, Canadian Apartment REIT, by virtue of the fact they're operating in rent control markets, they don't have the ability to capture that high mark-to-market in their portfolio right away. And what you're finding, because rents have gone up so significantly, people are reticent to move. So without turnover, they don't get that mark-to-market. So they do get a nice, couple percent increase in rents on when they renew. But the problem is today, in a high inflationary environment, they're struggling to keep their margins constant. They are doing a good job of it, and they're a very good operator. But if you're looking at cash flow growth, this isn't the name to own. But if you own it today, I think your upside is better than your downside, meaning is a good risk reward in the stock. So it's a solid hold. I feel very confident with their assets and the management.
Okay, well, that's a strong place to end things. Just for this break, we're going to be taking a little commercial right now. And after that, we'll be back with Andrew Moffs. Of course, he is the Senior Vice President and Portfolio Manager at Vision Capital. He'll be taking your questions on real estate stocks. Welcome back. We've got a caller on the line, Rocco from Montreal. Rocco, what's your question?
Good afternoon, gentlemen. My question is on Minto Apartment REIT. Unfortunately, I bought at the high, tried to average down, but still I'm in the red with the stock. Is it in a good position of cash flow? And obviously, is the interest rates hurting the stock? And do you think it's a takeover candidate in the medium term? Thank you so much.
So with respect to Minto, this is an apartment landlord across Canada. They own biggest concentration being in Ottawa, then Toronto, then Montreal, with a smaller portfolio in Calgary and Edmonton. It's fair to say their portfolio skews more to the higher end, more to the urban centers, and hence during the pandemic, that's where you saw the biggest exodus. So they suffered occupancy losses. The good news is, looking at the past quarter, occupancy is up, I think, almost 350 basis points year over year. So we've bottomed in terms of occupancy. They have turned the corner. Montreal's been a more difficult market to operate in. It's typically more of a foreign student market, and hence they've seen, that market's been softer, as well as it's had a lot of new supply. So we've bounced along the bottom. I think your risk reward is to the upside in Minto. It is a very good company, good assets. Is it a takeover? That's really up to the controlling shareholders, the Greenberg family. I don't see it as an obvious takeover today, but again, it's hard to get inside someone else's head. That said, it trades at the widest discount to IFRS values amongst all Canadian apartment REITs, and so it does screen attractive for that based on that statistic.
Okay, and the ticker symbol there is MI on the TSX. Continuing now, we've got Tim from Calgary with Slate Office REIT. What's your question?
Hello, guys. Hope you're doing well today. I was calling about Minto and Slate, so there you go. I'm getting two on the same day here. Slate Office, the current yield's around 8.8%, and the payout ratio is 36%. They've been growing, and it's trading at half book value. What do you think of Slate Office? Thanks, guys. Have a good day.
And the ticker symbol here is SOT.
Yeah, if you've heard me previously on the show, we're not bulls on office. It's a difficult business, particularly in this environment. We've been going through a secular reduction in space for many, many years, and now work from home in some capacity is going to reduce the need for space going forward. Slate Office operates in more of either secondary buildings or secondary markets. And that can be a good business. It's just very capital intensive. So you quoted the distribution yield. When you're in a business that is fighting just to keep rents and you have a lot of capital to put to work back into your buildings, it's hard to distribute that out to unit holders when you should be reinvesting them in the buildings. Slate Office is doing a fine job of doing that right now. We just look at the prospects, and you're looking at an office environment, double-digit vacancies. You're going to have to be very competitive in terms of paying tenant inducements, tenant capital improvements, leasing commissions, et cetera. So it's a name we're not ready to jump in on yet. It's a smaller cap name, so with it comes a bit more risk today.
Okay, next we've got Jim in Shibenacadie, New Brunswick. I apologize for my pronunciation there. What's your question?
Yeah, my question is on Choice Properties. I was just wondering your opinion on that. Would it be good to buy and tuck away for the monthly payment?
Yeah, I think that's a fair assessment. Choice Properties is the largest REIT in Canada. Its largest shareholders, the Weston family, and they control Loblaws, and hence Loblaws is Choice's largest tenant. By nature of that fact, it's very stable. They have a very solid portfolio, grocery anchored, Shoppers Drug Mart being a large anchor as well, and many of their grocery centers. The other thing that people don't appreciate is that Choice has one of the largest industrial portfolios tucked away within it. An industrial warehouse is a great sector to be in today. We think very highly of management. The company operates at a very solid balance sheet. I think they did a smart transaction in reducing their office exposure earlier this year in a transaction with Allied Properties. So I think you have a very solid 5+% dividend distribution yield today. It trades in and around NAV, so it's certainly not a bargain, but at the same time a very solid investment, and I feel very comfortable, as you said, tucking it away.
Great. Next, we've got Greg in Toronto. Greg, what's your question?
Good afternoon, Andrew. Andrew, I wanted to ask you, how is the pricing on private REITs done? And assuming it's based on the asset value in some fashion, is now a particularly favorable time to favor publicly traded REITs that are trading at a discount to their asset value? My follow-up question would be, what's the asset value of the European residential REIT, and do you view it as a good investment today? I'll hang up and listen to you.
Sure. Well, I'll start with your question about private versus public. I mean, the reason we exist at Vision is to take advantage of the inefficiency of publicly traded real estate. Simply put, there's an ability to buy real estate cheaper in the stock market than one can in the private market. So I think you're already better off on any given day buying in the public markets. Why? Because you have liquidity, you have transparency, you have complete corporate governance, and you can change your mind in an hour. When you buy into any type of private real estate, yes, there can be good corporate governance, perhaps there's good transparency, but you miss liquidity. And so we have a saying around our office where anytime there's a mismatch between the assets and the liabilities, meaning a mismatch between liquidity and both desired and the ability to provide it, it's an accident waiting to happen. And we keep seeing announcements almost on a weekly basis in terms of funds that are unable to satisfy either distributions or redemptions. And so private REITs generally, they're appraisal based. We all know appraisals are lagging. And in today's environment, that might be the case. But more importantly, even if the value is there, right now, it's almost been pencils down, meaning we've seen fewer transactions on a year-over-year basis. So it'll be much harder to provide liquidity going forward on some of those private REITs. So long story short, we definitely favor the public markets. You have a tremendous selection in terms of asset class and geography, and you don't need to go down the risk curve to go outside of the public markets. You did have a question on ERE, European Residential REIT. We think highly of this company. It's focused on the Netherlands. I was just there a few months ago touring their properties in Amsterdam. There's a supply and demand mismatch in that country, where there's a large mark-to-market in rents because of that supply and demand mismatch, and ERE is navigating that environment quite well. It trades at quite a big discount to net asset value, and we think that gap needs to close. Its largest shareholder, Cap REIT, agrees with us, and we'll see what transpires over the next several months to see if that gap can close.
Okay, well, opportunities abound, it sounds like, in Europe. Past picks are next. Stay tuned. Welcome back. Now let's take a look at the highly anticipated past picks. This is from November 29th of last year. We start with Boardwalk REIT. The ticker here is BEI for those who are tuning in via podcast. I see that you still currently hold this in your portfolio. Tell me, where do you stand on this business? The return has been lower, 8% this year.
Yeah, I remind myself that we think back a year ago, interest rates were 200 basis points lower. If you look at the REIT index, it's probably down about 18-19% since then. And this stock actually hit a high of almost $62 in March. And hence, for all those reasons, it's done pretty well comparatively, and we continue to own it in our portfolio. Boardwalk REIT is the play on multifamily housing in Canada, where more than half its portfolio is not subject to rent control. It's concentrated in Alberta. Alberta is in a recovery process. You think about occupancy levels, they've regained over 200 basis points year to date. Edmonton, which has lagged, has gained over 300 basis points. So now we're finally seeing pricing power in Alberta at a time where the rest of the country might be seeing a bit of headwinds. Why does Alberta win in this economy? We're seeing population growth. And if you look at the migration statistics, Alberta's been a net winner over the last period of time. So this stock continues to trade at a double-digit discount to net asset value, and we remain bullish on Boardwalk.
Okay, well, what do you think that long-term view is in terms of when we'll see the returns hit positive territory for the stock then?
Oh, I think what I like about our business, underwriting real estate companies, is so long as you can underwrite future cash flows, NAVs will increase, and stock prices have to follow suit. And we see nice cash flow growth. It's almost in the bag in the sense of you had to provide incentives before, and it's burning off. So we think there'll be nice cash flow growth next year, hence NAV growth.
Okay, definitely enticing. Let's take a look at Phillips Edison and Company, the ticker here, PECO on the NASDAQ. I see you don't hold it in your fund anymore. Why is that?
Yeah, we took the opportunity to divest of our position in the $35 to $36 range earlier this year. It hit our screen in terms of value, and we weren't shy to move on. It's a great portfolio of shopping centers across the United States, but we recycled that capital into other opportunities in the fund.
Okay, very succinct. Next, we've got Tricon REIT, ticker here IIP on the TSX. Where do you stand on the business today? You seem to still be holding it. Do you still have the same position as a year ago?
We do have a smaller position. Again, we took advantage of the stock trading higher earlier this year, but then we re-entered on the sell-off. Tricon is a stock that, on paper is worth over $18. Yet trades in the $12 range. It has a tremendous mark to market in its portfolio of about 30%. If there were to be, someone asked me, is Minto a takeout? I'd look to Tricon and say this is a great portfolio. If someone wanted scale in Toronto and Montreal and Vancouver, this would be one way to gain that. But even without that, I see great cash flow growth from this REIT going forward.
Great. Okay, well, we'll be back with Andrew Moffs. He is Senior Vice President and Portfolio Manager at Vision Capital. He'll be taking your questions on real estate stocks. Stay tuned. Whipsawing action we've seen for the markets today. I also want to bring some news that broke across the Bloomberg terminal earlier. This is about Canadian real estate firm Starlight Investments. It's halted payouts from 2 of its funds. I wanted to get our guest's opinion on this. They say that because of the size and pace of interest rates increase, it's been unprecedented and resulted in sort of a significantly higher than projected increase in terms of their funds, and that's why they've had to make this decision to halt overall. So what do you make of this in terms of sort of the growth and virility of this marketplace?
I think it's a very important piece of news, not that it speaks to the value of real estate or the value of publicly traded real estate companies, but it really speaks to structure. And in this situation, Starlight, I believe, had been growing using a portion of its balance sheet in variable rate debt. And they simply had a mismatch between what they were buying and versus where they thought they could fund it and take a bet that they could then term out that debt going forward. When we look to invest in our portfolio companies, balance sheets are probably one of the #1 things we look at. And whether it's long-term debt, you have a very low risk of roll in any one year, and particularly in this rate environment, having fixed rate debt. And so Starlight might very well have great assets. They just have an inappropriate structure right now in that their cash flows aren't there to meet their distribution requirements to their unit holders. We don't see that in the names that we own. And in fact, we own a Sunbelt multifamily operator named BSR REIT, ticker's HOM. And fundamentals are great. We were just talking with management last night. So I wouldn't want to read across from this news item to any of the publicly traded REITs.
Okay, that's interesting. So for the investors who are at home, they're investing their own private wealth, what do you make of sort of the whipsaw action when it comes to Fed speak, both out of the U.S. as well as Canada? Of course, we're going to be hearing yet more information from the chair of the Fed, Jerome Powell, tomorrow about where rates could be heading. Should they be reading and internalizing any sort of information from sort of the day-to-day machinations of the conversation around future rate hikes? Or what should they be focusing on if you are a private investor wanting to dip your toes in real estate right now?
Yeah, it's a great question. The day-to-day is difficult, and hence even how we underwrite, we look with a view 6-12 months out, what will be cash flows at that point, underwriting the interest rate environment 12 months hence. So you really have to have a long-term view. And you have to feel confident in terms of what you're investing in. You can help yourself by going on a top-down basis, looking in the right markets, in the right geographies, the right sectors, and then bottom up, buying at a discount to net asset value. It's harder to make a mistake when you're already trading at a discount. Your downside is somewhat limited, particularly in real estate. So I think you have to have a longer-term view as opposed to, as you said, the day-to-day machinations of the market.
And that's why we have a show like this one where people can get insight from experts, right? Let's move on to an email from Shannon. She says, hello, I'd really like to hear what Andrew Moffs thinks about Primaris REIT. The stock has done really well this year. They have a very impressive capital structure and just delivered 10% plus in Q3. Still seems to be under the radar. What are your thoughts on this stock?
It is a good point. It has done well this year. It seems to trade between this band of $12 and $16. If I had to throw out two numbers, yeah, there it is on the chart. So it's at the higher end of that range right now. The company spun out of H&R REIT, did a transaction with the pension plan Hoop, and came out with a very clean structure in terms of their balance sheet, and they've taken advantage of the market at times to buy back stock, which we think is a prudent use of capital. They set the bar, and they've met it in terms of every quarter, in terms of meeting what they've said they would do. And I think it's appropriately valued at this point. It's a mall portfolio, so you have to have a view from when I talk about it on a top-down basis. Do you want to own malls on a longer-term basis? Do you think brick-and-mortar retail can continue to perform as e-commerce sales continue to grow? Many of Primaris' centers are good assets, Dufferin Mall in Toronto, Stonegate Mall in Guelph, et cetera. Those are the go-to assets with high density around it. Other assets, you have to think about the long-term value. The nice thing about Primaris is many of their assets have an alternative use many years down the road. So at this point, it's a solid hold. Like I said, you can trade it within a range, and it's probably at the higher end of its range today.
Great. And the ticker symbol here, PMZ. Next, we've got a caller on the line, Mike from Sydney, Nova Scotia. Mike, what's your question?
Hi, question for Andrew is on Granite. Granite REIT, I know it's taken a nice run the past few months, and just what Andrew's thoughts are where it sits currently. Thank you.
Yeah, so, we own the stock. Granite REIT is now the largest industrial REIT on the TSX. Summit now being taken over makes way for Granite in terms of being a flow of capital. This stock used to have a high concentration to its largest tenant, Magna. That concentration has gone down by something like 20 percentage points over the last 2 years. And they have a portfolio in Canada, the United States, and Europe, and a good balance sheet. So we love sell-offs in this stock so we can take advantage of it and add to the position because we think they're a solid operator in a great market. Industrial warehouse is one of is a focus of ours. It is a great sector to be in with the whole change in supply chain, onshoring, reshoring are all buzzwords that will continue as the whole supply chain needs to change. And Granite is front and center in terms of taking advantage of that theme.
Next, we have Anne from Toronto on the line. She's going to be asking about a company, ticker symbol here, REI.
Hi, good afternoon. Am I on?
Hi there, yes. Anne.
Hi, sorry. Yes, may I please have, Andrew, your opinion on Ryokan REIT? Thank you very much.
Yeah, so Ryokan manages one of Canada's largest portfolio of shopping centers, concentration in the major cities across Canada. I think this is a very good investment. Ryokan, notwithstanding retail, is not necessarily in favor as a sector, generally speaking. Ryokan operates in a good segment of retail and has great assets in the right markets. And so this is a stock we think it's a buy, and we see a lot of value in the REIT, particularly in its development pipeline over the next several years. They've set a path in terms of cash flow growth, which we think they can meet over the next few years. So again, to your question, what can investors look to when they're investing in a REIT? They want to see a path to internal growth as well as adding to it in terms of external growth, whether it's via acquisitions, whether it's through redevelopment or development. And I think Ryokan checks a lot of boxes, so it'd be a name I feel very comfortable owning today.
We'll be back with Andrew Moffs. He, of course, is Senior Vice President and Portfolio Manager at Vision Capital, and he'll be taking your questions on real estate stocks. We've got an email question from Keith in Calgary. I would appreciate your thoughts on Tricon. The ticker here is TCN. I am still a believer in the single-family rental space in the U.S. long-term, given home ownership costs stateside are currently higher than rental costs. Good observation there. Would you invest in TCN, or is there a better choice in this space?
I'm definitely a believer as well. And I agree with that statement. Home ownership costs are much higher today than they were certainly a year ago when, mortgage rates, 6-7% in the United States when they were 2% a year ago. And even if you didn't have that increase in mortgage costs, you have to think about supply and demand. And the age cohort of those that rent single-family homes is typically in the 35 to 44 years of age range. And that cohort's going to have double the population growth over the next 5 years as the rest of the general population in the United States. Then you add to the fact that Tricon operates single-family rental homes in the U.S. Sunbelt, which is benefiting from migration as people leave high-cost centers across the U.S. coast to take on jobs in cities like Dallas, Houston, Phoenix, etc. The stock is trading at a very wide discount to net asset value, something like a 40% discount. We think it's a great opportunity sitting here today to be buying into a company that's focused on a high-growth business. They're benefiting from lease growth anywhere in the 8-9 to double-digit range percentage as they turn new leases. So we're bullish on the stock, and we just like the business generally.
Now we've got a caller on the line, Rupin in Cambridge, Ontario. Rupin, what's your question?
My question is on Northwest Retirement Home. The ticker symbol is NWH. I'd like to understand your guest's view. And I also like to understand his view on this healthcare or the retirement home REITs. Thank you.
So the question was on Northwest Healthcare and tickers NWH. Just to be clear, they do not operate in the retirement home space. They actually operate in the medical facility space. So they own hospitals globally, medical office buildings, etc. They operate in Canada, Europe, Australia, UK, and Brazil. By virtue of the fact that they operate globally, they do take on currency risk. They've also taken on a bit of balance sheet risk. What do I mean by that? Given they've had such large growth, a lot of it has been financed through variable rate debt. They purposely did this because they had a view that the assets they were buying 100% of, they thought they'd have an opportunity to put into joint ventures and take that capital and then continue to grow with that joint venture capital and then term out the debt at that time. This rapid spike in interest rates caught them offside, and hence the stock has suffered. They are still working through creating those joint ventures, but you do find them today with a bit more risk than the typical REIT. So it's a high risk, high reward type of stock today. Has a higher payout ratio and a higher yield, approaching 8%. So not a name for the faint of heart in terms of that kind of backdrop, but we do think the type of assets that they are buying are quality, more infrastructure-like assets.
Next, we've got a caller on the line, Jerry in Toronto. Jerry, what's your question?
Yeah, hi, Andrew. Wondered what your opinion is of CubeSmart. It's a self-storage stock in the U.S. Do you own it? What's your opinion of it from a valuation point of view? Is it a quality business? That'd be great. Thanks very much.
Sure. I actually had the opportunity to meet with the management team a couple of weeks ago down in San Francisco at an industry-wide conference. CubeSmart's one of the largest operators of self-storage facilities in the United States. Ticker is Cube. It's probably about a $9 billion market cap. I think highly of management. I like their asset. The asset class, self-storage, is a great business. There's a big debate going on in the market today as, this sector just had a boom throughout the pandemic in terms of having double-digit rent growth and very high occupancies. They saw no slowdown. Now there's a debate today. We see decelerating revenue growth, not meaning revenue growth is still positive, but it's just growing at a slower rate than it did previously. The big debate in the market is it decelerating because it's just simply seasonal? Fewer people lease self-storage spaces in October, November, December, or is there some sort of change because of the economy? I've been following this business for a very long time, and what we have always found is that it's very recession resilient. People will always need, it's a needs-driven business. Well, it's all the Ds that I've talked about in the past: disaster, divorce, dislocation. All these things will happen irrespective of a recession. So I like the business, and to me, it's trading at a discount to net asset value. I'd buy CubeSmart today.
There you go. Well, Andrew will stay with us. Top picks are next. Welcome back. Now it's time for top picks. The first one is First Capital REIT. Ticker here is FCR. What do you like about this business?
First Capital owns the finest portfolio of grocery-anchored shopping centers in Canada, frankly, globally. They own 22 million square feet of grocery-anchored shopping centers, but they have a further 24 million square feet of future density. That would be huge for any organization. That could be a REIT in of itself. Their shopping centers are in thriving neighborhoods where they have leading population density statistics, as well as household income growth. This REIT always used to trade at a premium to net asset value, yet over the past 5 years, it's traded at a discount. It's actually been one of the worst performing stocks over the past 5 years, notwithstanding the fact it owns the best assets. And when I talk about grocery-anchored shopping centers, these are more necessity-based retailers. Think Loblaws, Sobeys, Metro. I think together that's 20% of their rents. We think it's a great portfolio. We struggle with the fact that it trades at a discount to net asset value. Today, upwards of 27% discount to NAV on our numbers. And it's not surprising to us that we've seen some activism come into the stock, just because unit holders are looking for them to close the gap. We continue to believe in the portfolio. We see nice growth in the portfolio, both internal growth as well as that development pipeline, and hence we think there's a great opportunity to buy a solid portfolio trading at a discount to net asset value.
Next, we've got Sun Communities, ticker here SUI, listed on the New York Stock Exchange.
So Sun Communities operates in the manufactured housing sector, in the RV park sector, as well as in the marina sector. This sector, the manufactured housing community sector, which is the majority of their portfolio, is an extremely recession-resilient sector. If you think about it, this is like the last bastion of affordable living in the United States. People own their home, and they simply pay land rent to go into one of these parks. There's a supply and demand mismatch. They're no longer building any of these, yet people continually want to live in these parks, particularly in geographies like California and Florida. Then if you look at the business itself, you still have, call it 6-7% rent growth next year. Everyone's concerned about a recession. Those are some great numbers. On the RV side, it's even higher, probably around 8%. And then even on the marina business, there's something like 12 boats for every one slip in the United States. So we love businesses where there's a supply and demand mismatch. And in this situation, particularly on the MHC side, they've never had a down year in terms of NOI growth. So we love the idea of buying this company. It trades at over 20% discount to NAV. It's very rare where you can buy this business at a discount to NAV. It typically trades at a premium, just like First Capital.
Okay, very interesting opportunity there. Finally, Dream Industrial REIT, ticker here DIR.
So Dream Industrial, of course, operates in the industrial warehouse sector. A very significant transaction happened earlier this month. Summit Industrial REIT is the subject of a takeover by a joint venture between the Singapore private sovereign wealth fund GIC and Dream Industrial in a 90-10 joint venture where Dream's only contributing 10% of the capital. That was purchased at a very attractive cap rate, $270 a square foot. And if you extrapolate those statistics to Dream Industrial, you find a stock trading some northwards of $18. Meanwhile, the stock today is priced around $12. I think what's most important about that Summit takeover is it shows that a very large, sophisticated foreign capital source was looking to come to Canada. They're looking at the public market, seeing the opportunity to buy real estate on sale and see the value in the private markets here. And so that really validates the Dream Industrial story. It also validates the Granite REIT story. And so hence we're quite bullish on Dream Industrial and their business prospects looking forward.
That's great. Well, thank you so much, Andrew, for joining me today. Everyone really enjoyed your insight as well.